Right now, retail investors are eagerly waiting on the sidelines to buy into the upcoming public offerings of SpaceX, Anthropic, and OpenAI. The expectation is that getting in early on these AI companies will guarantee astronomical returns. But experienced traders look at this buildup and immediately think of the late 90s. Between 1999 and 2002, over 300 tech companies went public. When earnings realities hit, posting 5% growth instead of the expected 15%, the bubble popped and the Nasdaq collapsed by 78%. We saw a different version of this cycle between 2021 and 2023. Highly hyped single-product companies like electric vehicle makers debuted to massive fanfare, only to see their stock prices crushed by 95% in a single month when governments hiked interest rates to combat inflation. That recent history is driving current market anxiety. There is a real fear that absorbing fresh liquidity to prop up new, speculative AI companies means we are entering phase 3 of a historical crash cycle. So the question is, are these highly anticipated AI IPOs destined to go bust? And if they do, will they drag the entire stock market down with them? Predicting the future requires looking at the current tech market as two distinct ecosystems, each governed by its own set of financial rules. The first ecosystem is comprised of the speculators. This group commands massive public attention and hype, but beneath the surface, they carry deep structural vulnerabilities. Take SpaceX, for example. While they recently reached profitability, they suffer from what the industry calls key man risk. The entire valuation and operational stability of the company relies heavily on a single individual. If something unexpected removes him from the equation, the stock price faces immediate severe volatility. Anthropic has a different structural issue: extreme revenue concentration. Right now, a single product, the Claude AI model, is expected to drive billions of dollars in recurring revenue. The entire corporate valuation is balanced on one specific piece of software remaining dominant. This visual breaks down OpenAI's current capital flow, exposing their critical weakness: an unsustainable cash burn rate. To earn just a single dollar of revenue, they are currently spending $1.69. If any major client pulls out or the broader AI build-out slows down, that heavy cash burn becomes incredibly dangerous. In finance, we call this being priced for perfection. It means that even if OpenAI, SpaceX, and Anthropic achieve their aggressive growth targets, their debut valuations will be so bloated that there is virtually no room left for the stock to climb. Because retail buyers are left with no upside, and the companies themselves carry severe structural risks, a localized crash specifically for these newly public stocks is highly probable the moment AI hype stalls. Now let's pivot to the second ecosystem, the foundations. These are the established tech giants like Meta, Microsoft, and NVIDIA. The key question is whether they face the same fatal risks as the speculative newcomers. This line chart plots Meta's price-to-earnings ratio. Trading at a PE of 18, it sits comfortably below its 10-year historical average, proving they are priced conservatively based on real earnings. Transitioning to NVIDIA, the center of the AI hardware boom, it's trading at a multiple of roughly 23. Despite massive attention, it completely lacks the exorbitant bloat seen in past bubbles. During the 2000 dot-com crash, the market collapsed because companies missed their earnings targets. Today, these foundational companies are backed by verifiable, massive infrastructure spending directly from the governments of the US and China, heavily insulating them from a sudden earnings recession. And unlike the 2021 crash, current inflation rates are relatively low and stable. That removes the threat of governments aggressively hiking interest rates, the exact trigger that crushed the market 3 years ago. The data shows that the established giants are structurally secure. Their growth is driven by massive, verifiable earnings and reasonable valuations, entirely separate from the speculative mania surrounding the upcoming IPOs. That gives us a direct answer to our central question. Even if companies like OpenAI and Anthropic go public and suffer a brutal 40 to 50% post-IPO crash, they are not going to drag the rock-solid market leaders down with them. The two tiers are disconnected. These foundational tech giants is a massive, unpredictable external shock. Think of the sudden global lockdowns in March 2020, an event entirely separate from the AI industry that paused the global economy. For retail investors trying to navigate this landscape, the first rule is simple: do not chase the explosive run-ups of these upcoming mega IPOs. When a company is priced for perfection, the early institutional investors already made their money. If you buy in late hoping to ride the hype, you aren't investing. You are simply providing the exit liquidity for Wall Street to cash out. Instead, the actionable strategy right now is to keep about 15 to 20% of your portfolio in cash. When the speculative IPOs inevitably experience intense volatility, the broader market often reacts with temporary panic. That cash allows you to buy the dip on the solid foundational companies. Building a portfolio for the AI boom depends on recognizing this two-tiered reality, anchoring capital in solid foundations to withstand the inevitable volatility of expensive speculations.